welcome to the Investing Master Series. My name is James Boyd. Alongside with me, my good friend Barbara Armstrong in the chat. We welcome her. Say hello, Barbara. Now, just real quick, we've got many of you with us. We got Grace with us. Hello, Grace. Ron with us, Texan, Scott, JP, and many others. Good morning to all. Let's go ahead and hop right in. Now, some of you remember that green shirt I wore yesterday. You know, I'm married, and sometimes I like to kind of make decisions to see if my wife really loves me. I put it on. She says, "You wore that yesterday." It was a lucky shirt. So anyway, I had to change. Just real quick as we get started, a little fun there. Just want to give us a quick reminder that this is being broadcast out on YouTube. This page right here, the Trader Talks webcast, you're going to see that you can subscribe to that. It's free. That way, anything you subscribe, you can actually go to the channel. You can see the videos. You don't have to be sitting on a computer. You can be a dentist's office or whatever and be watching or pulling up past classes as well. Second thing I want to make sure that you're aware of, just so you're kind of familiar with some of the material that we've covered. Last week, we talked about trading cash secured puts. How many of you went out and practiced those examples? Now, by the way, we get more of those here today, okay? Now, by the way, you're going to kind of see a main vein of strategies that we use, especially for bullish, okay? How many of you went out and practiced that strategy? Then we talked about 2 weeks ago, learning to exit bearish positions plus new caller positions, okay? 3 weeks ago, investing is math, psychology, and discipline. Really been kind of hammering down the points of being disciplined and really less emotional, right? Focusing on the principles of investing, not the current state, okay? Now, also want to give us a quick reminder that you can follow Barbara right on X. She posts educational content there daily and weekly. You're going to also see that, for example, you could actually go to my X page. I'll put that right there. All right, now JP also mentions and patience. Yeah, if you're running a business, it's not like an overnight thing, right? If you're in real estate, it's not an overnight thing. It's not just buying the place. It's renting it out. It's actually, contracts, blah, blah. I mean, anything takes patience. Kids take patience, okay? And I won't even get on that topic. I got 4 of them. Now, the biggest actually thing is, so JP, you're absolutely right. Yes, it takes patience because we're talking about investing capital over time. And that keyword is time. Now, also remember with what we talk about here today, the information we talk about is done for general informational purposes only. This class, we talk about stocks, but we also talk about options. If we talk about options, remember that options are not suitable for all investors. When we talk about, for example, our examples will be done in and on the software application, the desktop version, and we're going to be using the paperMoney platform. Now, you can download that right on Schwab.com. When we talk about investing, we understand that it doesn't matter if the market's going straight up, like 2017, or the market's down. We take risks. We're calculating that risk, finding out what that risk is, and seeing if we're comfortable with taking that risk. Without risk, there is no reward, okay? Those two go hand in hand. Now, when we also talk about short options, those can be assigned at any time, just like we talked about yesterday and today. And so you just need to be aware of that. What does that mean? Are you okay with that? In our examples here today, we'll talk about some of the market conditions just real quick. We need to talk about some past examples because we got expiration week this Friday. And we'll talk about some stock and option positions. And from those might be examples of just exiting in general, but maybe rolling positions, which means getting out of what you have now, and then reestablishing new positions with new expiration month. And we'll talk about some of the themes we've been actually seeing in the market. So first off, we've been talking about the last couple of weeks, and by the way, this is what I enjoy. When you kind of see like a process, right? The one thing we've been watching over the last couple of days is obviously oil prices. We know that oil prices shot up, and that actually had an effect on the stock market, among other things. And we're watching to kind of see, can this chart continue to go down? Okay. Now, 4 charts we've been talking about: crude oil, VIX, US dollar, and rates. We said before, if these crash to the upside, the U.S. markets and world markets might get pressed down. They did. Now we're asking ourselves the question, which is, if these start to go down, could the U.S. markets and the international markets go up? It's like a teeter-totter, right? Now, crude oil down at 93.90. Now, let me ask you this question, okay? If oil goes down, what are some themes that might benefit if the oil price were to go down? Type those in the chat, okay? Now, give me all of them. Don't just say, well, I'm going to tell them this and I'm going to hold on to that one for myself. Don't do me like that, okay? Tell me some themes. Now, when we actually take a look at, let's say, the VIX, do you, ladies and gentlemen, remember when the VIX was at 35 and we were like, oh no, it's horrible. Okay, now, and the VIX got to about, let's say, 31, 32 about 10 days ago. And here we are down in, well, we actually literally went to 17. Now, remember, when the VIX is high and falling, this is where some investors might say, hey, if the VIX is falling, the trend of many things are probably going to the upside. I think we get it, okay? Now, historically, we would say things like when the VIX is high, it could be the time to buy. I think we could also say it as when the VIX is high, maybe instead of being more fearful, there could be less fear, okay? And so when that actually VIX is falling, trends up, but also the premiums volatility is contracting. So you might say, well, I wish I would have sold some puts when the VIX was higher. Well, you reap what you sow, okay? You shouldn't get a benefit if the investor didn't do anything. Now, some of you are trading in the paper money account, some of you are in real. But the moral of the story, you shouldn't win a trophy you never ran a race of or in, okay? Now, remember my comment upon the YMCA that not everyone gets a trophy just for showing up? Well, so is the world. So is life, okay? Don't get Barbara talking about that. She'll tell you all about it. Now, if we take a look at this, the CGI, the 10-year, you're going to see that this has also been kind of grinding to the downside. The last one but not least, which has been very interesting this morning. Oh my gosh, it's so hard to sleep sometimes because you're like, wow, look at the moves overnight. Now, let me ask you this question. If you see this chart going down, what are some potential ideas? Now, it might not pertain per se to this class, but some of you don't live in the U.S., okay? And so if this chart is going down, think teeter-totter, right? If the U.S. dollar is going down, what is actually going up? Oh, man. There's so many overnight that were popping, okay, to the upside. I can't show you. But as you can imagine, some of those non-U.S. currencies were benefiting from the U.S. dollar grinding to the downside. Some of you enjoyed that. Now, let's kind of talk about some of the examples we're seeing. I want to bring up just real quick gold. Gold, I wouldn't say necessarily it's ripping to the upside. It had a nice hammer yesterday, but it's definitely setting up in terms of like a short-term ascending triangle. So in the short term, we're getting to that apex. Would it be surprising to actually see gold go to the upside? No, not really, okay? Could actually the U.S. dollar going down help that position going up? If there's somewhat of an inverse correlation? Yeah, it could, okay? When we actually take a look at high-ho silver here today, now remember when we're talking about these, we're not trading these, but we're trading the stocks that are in that industry group, like gold, silver, copper, and so on, or oil. Now, if you look at silver, same thing we saw. We're seeing silver lead to the upside, and we're seeing that apex kind of being breached, poke to the upside. That MACD has been Mr. Faithful or Mrs. Faithful, could be both. But staying above the zero line, which tells us that if we're in an area of resistance and the MACD is staying up, the chances of breaching resistance are becoming probably greater than 50-50. You tell me what the percentage is. The other one that we want to kind of keep an eye on is also that copper, that shiny metal. And if we look at, let's say, copper, this has been one we talked about yesterday. Name the two companies when you think of copper, which two companies in the copper space could be getting a move. Now, if you scan for it, there's only two. Number one is FCX. Number two is SCCO. So that won't take very long, okay? So seeing copper go up That's an expansionary sign for the economy and or economies. Now, if we take a look at, let's say, just real quick, the cash indexes briefly before we look at, let's say, our markets. One of the things that we talked about that I don't think gets talked about enough, but I think it takes quite a bit. I would say you have to be a little bit more advanced to kind of see it, which all of you, I'm going to help you kind of get you to, right? If I want to go back to one thing that I posted on X, and I've triple posted it, okay? We call it snapback rallies. I posted this on April 3rd. I did a video of this. If you said I didn't see that, could you send me that? On April 3rd, about what, 11 days ago, I said, hey, there's a
Have you
lot
ever
of
seen
things
a
right now that
stock
kind of really look
where
like
it breaks support and
me-
you're thinking the price?
Yeah, let me pause that. The biggest actually thing is back 11 days ago, there's a lot of things showing some snapbacks. Now, in our examples here today, I'm just going to show you a little bit more follow-through examples of that. Don't think that if you weren't there on April 3rd, that there's no more examples. That couldn't be the farthest thing for the truth, okay? Now, if we look at the SPX, this looks like your classic V pattern. Now, what I've learned from investing, okay, is when we talk about these V patterns, we're talking about something that has been driven down in price, okay, driven down in price. And I'm looking really at the number of days, okay, number of days, okay. Like when we fell down, like how many days did we go down? Now on the right-hand side, how quickly did we go up? Now I'm not sure if you can tell from this, we could do this. How could we see the number of days? Well, without counting, we could actually just say, look, we topped out right there and we fell down, and we're getting an idea of how many days was it to the downside. In that little rectangle box, it's 24 bars, which means 24 trading days. What's been so interesting here is the move back to the upside. It's only been 11 days. Now, there's some sayings in the stock market that says when stocks go down, they take the elevator shaft down and they take the stairs back up, higher highs, higher lows over time. That's not what we're seeing. We see that it took the stairs down and it's taking the elevator shaft straight up. Why do I say that? Well, if the duration of time is to the upside is shorter than the duration of time it had to go to the downside, the chances of taking out that old high. You guys and gals know where I'm going with this. What do you think I'm going to say? Okay, well, okay. Now I'm going to tell you exactly what people say when the market's going up. Yeah, when we were right here, well, we don't know for sure. We'll have to wait and see. It depends. We got a lower high. We'll have to just see and wait. We'll actually have to see if it actually holds. Blah, 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 blah. The more of the story is they don't know about reversals. They don't. Just say that, okay? Just because someone has an opinion doesn't mean it's right. The more of the story is when we break diagonal resistance, we've made a higher high. And when we make a higher high, it's the highest chance to make a higher low. You break out, you make a high, you make a higher low, then you actually see the change in trend. That gap up day right there is 67.58. We never went back down to that level. And so that gap up day held. Remember, on the gap up days, the open of the green candle, that's the potential support area. Now, remember what we've been saying. Nobody says it the way we say it. When we break inside the old channel, okay, the path of least resistance is you go to the top of the channel. A smart bear, once they actually break inside the old channel, would know, I don't like to be in this position. If they're bearish, that trade might not last very long, and it might quickly, potentially, ascend to the top of the channel. Well, here we were. We poked our nose inside on 4.9. Just what? 4 days later, we're 80% of the way through the channel. Why maybe a beginner investor is saying, is it time to get in? Time to get in. The times to tend to get in is when the VIX is at the highest levels, okay? But it was scary. Look, that's when actually the risk is smashed the most. Tell me if you get it now, okay? Now, the biggest thing that I'm going to say is if the duration of time to go back to the upside is less than what it took to go to the downside, the chances of us taking out 69.90 is extremely high. Yeah, but what about the news? What about this? Okay, more of the story, technical analysis is showing something different than what, the news, this, that. Okay, a lot of the market participants are not as concerned as your friend is or your neighbor, whoever's saying that. When you look at this chart, we now see that the moving average on the weekly chart, we're starting trying to get a crossover. Now, I know what you're thinking. Yeah, but we haven't made a high or low yet. Yeah, but you made a high. And if we make a high, the greatest chances that makes a higher low. Wonder if we actually see oil keep going down. Wonder if we see dollar keep going down. Wonder if we actually see the VIX stay down. Wonder if we see rates actually hold lower. What's the chances of that actually taking the upside? Pretty high. And when we actually take a look at, let's say, these stocks, we cannot say, okay, we can't say that that's a bad sign. Now, you take a look at, say, the IXT, the technology sector, that's not a bad sign. Discretionaries, communications, financials, they're all showing some aggressive moves to the upside, different than most people's emotion. And so this has been another clinic in actually when the VIX is high. Those investors who have experience, they tend to buy something. Do they buy everything? No, but they buy the ones that are showing that relative strength. What's your two favorite words? Relative strength. Okay. Now, speaking of actually relative strength, let's go to our first example. So remember when we talked about that crude oil stuff, that black stuff? Let's go just real quick to DAL. Now, DAL, and I want to kind of show this just real quick, okay? So DAL kind of popped to the upside and then it fell back down. Now, remember, one thing that we've taught very clearly is it doesn't matter if it's a red candle as long as it's holding above the moving average. Yeah, but I didn't put any yeah, but, okay? If we get a red candle, we're still staying above the moving averages can act like a level support. So when we ask, hey, I'm looking for a bounce setup, what are you looking to see? Well, we look for really two main types of candle patterns. A close higher gap, which is a 3-candle pattern, or a close above the high of the low day, which tends to be a 2-candle pattern. Could be 3, okay? Most of the time it's actually 2. So if I go forward on this, we see a red candle and then we see a close higher day. Well, there's 2 candles so far. So on the close higher gap, it starts with a red candle. Then you close higher. That is not close above the high of the low day. But when you see that, what are you thinking? Type it in the chat. I'm telling you, if you don't type it in the chat, it tells me you don't understand it. And it makes me feel bad for people that don't understand it, because this is probably a third of the way people see entry setups. Well, if you see the close higher day, and we saw this morning, that's why I'm bringing this up. If you see that price gap to the upside, now what might give us the idea that it's gapping to the upside? Well, first off, if we see crude oil dropping or dropped, the investor might say, well, geez, could maybe airlines go up, playing that correlation. Well, let's go look and see what it did. Did it gap to the upside? It did. Now, let me show you, this is a perfect example. Let's say the investor buys in the morning and then by the end of the day, it's down. If it gaps to the upside, which it did on the 10th, does it guarantee that it's going to go up? No, it's a setup. Just because you buy it doesn't mean the stock can't go down. And it did. It opened up at 68.15. It closed at 67.82. Oh, no. It was down 33 cents from the open. Not probably back-breaking, okay? But it was down. But some investors took that entry. Now, we get a new red candle. What do we think about the new red candle? New close above the high of the low day, or trade above the high of the low day. Now, we go forward to the very next day. What does it do? It goes down. So if you got in actually there, you could have been stress tested in terms of a stop. Now, we go back to the same thing we talked about before. Close higher gap. Red candle, close higher, not go hold. And then what do we see the very next day? Doink. Now, we might be thinking, my gosh, let's go back to JP's comment. Why did the investor get in here to have the stock go down about $2 from where you got in, only to see it go up? Well, it was really seeing if you were going to hold to that trend and the plan you had. Now, I want to go back to this for just a sec. Remember we talked about trading short puts? Let's go back to this chart for just a second. So remember the 2 acronyms we've talked about: close higher gap, red candle; close higher, green candle, gap. Okay, we showed those gaps don't always work, and this is an example of that. I want to follow through. The second one worked so far. That's a key word, so far. Now, when we go back to this chart, let's look at trade example number one. What you're now going to see is the prior highs at 75.40. Now, we could be thinking, well, why don't you do this trade earlier? We do the trades in class. Okay, so if I go back to this, now, could someone have actually done this entry on the morning when the market opened? Yeah, but we didn't have a class when the market opened. So what I'm going to do is I'm going to go back to the margin account for just a second, trade. I'm going to go to the DAL. And by the way, I'm going to come to another one. Speaking of actually why we're bringing this up, the previous example that we had on this was a short put that was entered on 323. Sold it for actually 346. It's at 10 cents. Okay. Now, the 10 cents represents how much more money you can make, or 11 cents, in the next 3 days. To stay into the position, you have to hold margin to be in the position. Now, what people don't understand, okay, is would you stay in the position if the most you can make is 11 cents or $11? Would you risk $335 plus more to try to make the last 11 cents? And the average person that is truly thinking would say, that is nuts. Now, this morning I had a conversation with someone that said, I have 3 cents left to make. And I'm like, why are you staying in the position? If you only have like 3 cents or 10 cents left to make, you're holding margin. You're holding $782 to try to make the last 10 cents. I mean, look in terms of that, in terms of the rate of return over 3 days. It's going to have a lot of zeros in there. And the more zeros you have, the more it really means doesn't make a whole lot of sense. Okay? Now, I'm going to go ahead and right-click on this. I'm going to create closing order. Now, you might say, well, I didn't do that trade in a paperMoney account, so what does this have to do with me? Well, number one, I got to close it, and I want to take the 335 with 3 days remaining, plus we've actually hit pretty much the cap, okay? We cannot make more than what we've sold the put for. Now, selling puts is an income strategy. Selling puts is a probability strategy. Selling puts is a potential stock buying strategy. Selling puts is about a trend that's a little bit more neutral to bullish. Selling the puts is a lot of things. Now, by the way, could that be a short, wide put vertical? The answer is yes. So number one is I'm going to try to buy it back for 10 cents. That does not mean that there's not a commission because it's not a nickel or less. Note the commission there, send the order. Now, what we're going to do in this case is if the investor said, well, I'm going to go to the May expiration there, and I'm going to go down to the strike that actually is the first one that's out of the money. It fills. The first one out of the money we see is the 70. Now, if I click on the 70 right there, just by itself, it's just selling the put by itself. We're in the margin account, and I said that for a reason. When we do this, we're going to try to push to the 280. So trade number one, selling the put on DAL. Now, clearly, if you're going long airlines, you think that that oil price is going to go down more. Now, we've talked about kind of what we saw in oil pricing in the shorter month to the backdated month. Keep an eye on that. I already posted about that last night. If you didn't see the post, well, I can't do everything. The biggest actually thing is when you look at this, we're going to set that at 279 because the price moved. Okay, confirm send. And what we're going to do is we're going to do a paperMoney example of following through on what we did last week, which is we're going to try to do a trade. Now, you could actually say, note the commission there, send it. If this stock, let's say, gets to, let's say, that top, and I'm going to right-click right there, we're going to say, in this case, create an alert. And that create an alert on the chart is exit short put at prior high. Now, we already know what that means. The comment is if the stock goes up, the put value goes where? The stock goes up, the put value goes where? Put value goes down, okay? The longer it takes for the stock to go up, the more time decay that's happened that's pushing the option price down. If the stock goes up, where does that volatility go? The answer is tends to be going down. So you get what we call the triple whammy in a good way. Price up, time decay going by, okay, and that volatility going down. And if those three things can happen, hallelujah. Okay. Now I'm saying we're trying to ride that trend. Again, you're saying, why didn't you get in this morning? Didn't have the class this morning. I was waiting for the class. Okay. And what we're saying is if we go up to that price, could we try to sell into that prior high? Now, can you name me another airline stock that might have not gone up as much as Delta yet? Can you name one? Now, here's the deal. We're going to keep the A and the L. We're going to take that D out and we're going to buy a vowel. Can I get a vowel, please? UAL. Now, why am I bringing it up? Well, notice that UAL, some people say, oh, I don't like to buy stocks at highs. Well, who did you marry? You didn't marry someone that was at an all-time low. You married someone that was at the all-time high. You thought if you married them and combined two people at all-time highs, that you could trend together. Now, don't worry, I did the same thing, and it worked out. Now, the big actually thing is when you take a look at this, we're going to see that this earnings is on the 22nd. Now, some of this is actually going to be already built in that maybe they thought there could be volatility in the earnings, hence the price has already gone down. Fair? Okay. Now, Delta's already announced. Okay. That might actually help, even if they, it's already kind of told some investors what those earnings might be. Now, if I were to ask you, is this maybe starting to reverse out of a basing pattern? What would you say? Yes or no? Is it starting to reverse out of a basing pattern? If we said 95.85 was the top of the channel, could it maybe be trying to break out of the top of the channel? Speaking of doing a trade to get more practice, well, that channel right there is $10 or 12%. If I take that, add $10 or add $10, now the percentages are going to be different because the stock price goes up. It's not going to be the same percentage because the price was lower when I measured it before. But if I measure the nominal amount, $10, it's going to be right about there. Right about there is really that old support area. And traders, they kind of do this where they'll try to buy low, sell high, or buy high and try to sell where it was higher before. They kind of play within lines or trade within lines. Now, what I'm going to do in this case is we're going to be a little bit more aggressive. Now, what do I mean by more aggressive? Does anybody know? Well, if I say language like, hey, we're going to be a little bit more aggressive, being more aggressive actually means that we're probably going to be selling at a higher delta. That's one way to say it. Or selling a strike closer to the current stock price. Now, what's the risk? Well, the risk is assignment, okay? Which can happen at any time. If you sell the put, we're saying we're okay with buying 100 shares of the stock at or from the time we place it until expiration. So in this case, what you're now going to notice is we're going to double check, is that something that is showing kind of tight bid-ask spread? For some reason, as much as we want to do this to practice, that spread is, you could drive a truck through it. So even though that's something we might want to try to do, the investor might say the spread is just not letting us. Okay? Well, you could. It's just the spread is, well, very wide. I'm going to go down to where we're seeing something a little bit more where the spread is a little bit narrower. Okay? Well, and by the way, so you might want to be more aggressive, but when you go look at, let's say, the option pricing, you would say, geez, I like to see 20 cents or narrow. That's not what's happening. So it might cause you to change the strike that you're picking, or if you can do it at all. What we're going to do in this case, we're going to sell the 92.5. Now, why didn't you pick the 95? Same thing, 90-cent bid-ask spread. That's a lot for a $5 option. We're going to click on that 360. Where's the mid price? Now, trade number 2 here. We're going to sell the UAL. Now, again, if you're doing airlines, if you're going long airlines, you're going long airlines as far as the group, you're going airlines, individual stocks, you're thinking that oil prices are going to go down, okay? Now, if you actually sell this, we're going to push it to the 375 mid price, confirm and send. Now, when you sell this, you're obligated to buy the shares at the strike price from now to expiration. So you got to think to yourself, if I had to buy the shares, how much capital would it be? Answer, $9,250. However, you also got a credit. You didn't make it yet. You received it. Okay? And now you see the break-even price, $88.75. Short strike, less the premium. So really what we have at risk is $88.75 or $8,875. Max profit, max loss. This is assuming the stock goes all the way down to zero. Note the commission. We're in the margin account. How much capital is set aside to be in the trade? Answer, $13.31. Okay. Now, James, could you buy the put to the downside to make it less? Yeah, sure. James, why are you actually hammering that margin account here today? That margin account actually was kind of underperforming. Well, it was. But actually now on a percentage basis, that's actually doing better than the IRA account. And the IRA account got a little ahead, and I'm making sure that that margin account gets a little effective use of capital. Okay. Now, any questions on what we did? So we did trade number one, Delta. We did trade number one. Trade number two was United Airlines. Any questions? Now, by the way, this is not a new topic. This is what we talked about last week, but we're just practicing two more examples. Okay. Now, if I said to you, James, I'm concerned. I don't know what could actually happen. I don't know. I don't like to invest around earnings because I don't know what's going to happen. We never know what's going to happen. Okay, we realize that. Now, let's say the investor, trade number three. I'm going to buy the shares of the stock and I'm going to hold it over the earnings. What is the type of strategy where the investor might do that? Well, if we go into that margin account, let's go to the trade tab. And if I buy the shares of stock, click on the ask price, okay? Could I move it down to maybe the mid price? Yep, we'll do that. Number two is what we're going to do is we're going to come down and try to sell the call. Now wait, if you have shares you can sell the call, that's your classic covered call. Problem with the covered call, that's not downside protection. Okay? Now what we've said and what we've always are going to repeat is the number one reason why people don't buy puts. Number one, they don't trade options. The second reason why people don't buy puts is they don't want to pay for it. Okay? Now, in a way, we're trying to help getting paid. So we're going to go to the call side and we're going to say, look, we're going to sell the 45 with a 36% chance it could be a penny above the strike as of right now, and give us some premium. For what? For what? For what? Well, we're going to sell that. And what we're going to try to do is we're going to try to get $1.50 to sell it. What are we going to do with that $1.50? Well, we're going to use some of that $1.50 to help buy the downside protection. So a lot of times when people go over earnings or into the earnings, they're so concerned about the downside. Well, some people, they're stock traders, or it's someone that trades even ETFs. It doesn't have to be stocks by itself. They might say, hey, I'm going to go ahead and actually just collar the position over earnings. What does that do? Now, notice that the put that I'm buying, if we think there's a greater chance that it might go to the upside, the investor might buy a put slightly lower than normal. What is normal? Normal for us would be a delta of 30 to 40. If they think there's more of a bias to the upside, they're going to pick, or they could try to pick, a put that's farther out of the money. That put that's farther out of the money has a lower delta. That's negative. And actually, in that case, the overall position would be more bullish. Okay, now, we pull this up, we can actually bring this up on the analyze, and the third trade that we're going to look at, I'm going to right-click on that, analyze that trade, right-click on that, put right there, analyze the trade. And when we bring up this position, let's only bring up what we just did. Remember, that collar looks like a vertical, a bullish vertical. And now what you're going to see is if we said, look, wonder if actually Love announces horrible earnings and says, hey, look, we're going bankrupt. Well, if that actually happens, we have a right to sell the shares at the strike price from now until expiration. Who controls the right? The person that bought it. Okay? Now, so the max loss on that trade, about $400 down. If the stock were to go to the upside, what's the most we can make? The answer, it's about, well, 350 bucks. Where could we also see that as well? Look in the bottom left of this price graph, okay, and look at that aqua blue color, and we'll see what's the maximum gain. And it's right around about $350-ish, okay? Now, if we take a look at this, yeah, so here's the question, right? I lost big on Meta last year. I'm still in my feelings about it. So here's the thing is, if you don't like, so first off, does everyone set stops? They don't. If you said, hey, I don't want anything that could actually go down quite a bit, let's say if you sell a put, etc., okay, you might say, I don't want to have something like Meta that goes down a lot and there isn't a floor. So the investor might try to put positions on where they can have a put. The problem with the put is it's not indefinite. There's an expiration there, okay? So that's the first thing. The second question that was asked was talking about letting trends trend. So third trade we're doing is if you said I'm a stock trader, this strategy is so applicable because we're going into over earnings on many stocks. We're going to confirm and send, and this allows us to stay invested while having defined risk and reward. We're going to send that order, okay? Now, I want to kind of state something. Let's say we're in a situation, and I'm going to say, let's say example given, and let me go back to, let's say, the IRA account, etc. Let's say we sold a put, and that put, let's say, has gone down, and it's gone down, I mean, a lot. Well, we're not ever planning that long put is going to become worth something. But if it does, that there's a backstop to it. Now, not only is there a backstop or a floor to how bad it can be, the second thing is there's also some neutrality of the volatility, okay, as well. So it's the price decline, but also it's helping the volatility be more neutral. Because if we sell the put and the stock goes down, we get negative price movement, meaning price down, and we get the volatility going to the upside. Well, at least if we bought a farther out of the money put, which we say delta 10 or less, that is trying to help those two situations, okay? All right, now, let's go back to just real quick. So the question on letting the trends ride, okay? Now, how many of you have struggled to let the trends ride? How many of you have struggled? Now, JP of actually, now, by the way, I'm going to put my hand up, okay? First off, why is that the case? Well, sometimes we don't know what we don't know, and we're uncomfortable. When you're uncomfortable, you're going to lean on emotion, okay? So first off, and I want to kind of show you this, the moving averages that we're looking at is at 10-20. The shorter the duration of the moving average, the more sensitive it is, okay? Now, so what that really means is if we go through periods where the moving averages are really more green, the investor would say, let the trend trend, okay? Now, even though we know that mentally, when this stock goes down, we start having thoughts like maybe I should sell it. Maybe I should sell it. And then all of a sudden, maybe I should sell it. The difference between on March 31st and this one, and this one, and this one, is that both moving averages were red on the moving average line. That's the difference, okay? So now, by the way, how do you try to learn how to let those trends ride? Number one, you become comfortable with the tools, okay? Understanding what's going to cause those moving averages to change color, okay? Number two is you might say, hey, I know the 10-20 is more sensitive. Maybe using the 10-30 is helpful, okay? Where it's not as sensitive. The second thing that I think is helpful is really when you go to style, Hakanashi candlesticks. Now, if I use Hakanashi candlesticks, what that's going to do is it's going to smooth out the noise of the candlesticks. Now, so what that would do is it's normally going to take 2 down days before we get a red candle. Now, in this move before, we saw a red candle somewhere right around here and somewhere right around, we don't even see it. Well, the Hawkinashi, the formulation, it's different than a standard candle. It's really saying to get a green candle, we need 2 up days, okay, to go from selling to buying, and then to go from where it's going from buying to selling, we need, this is showing the exact same, but there. Now, there are some people that they are buying off the Hawkinashi candlesticks. You need to understand something. It's more of a candle. It's a way to try to ride the trend, but you need to understand that this is going to look a little different on regular candlesticks. Look at the formula, okay, of that, which you can see on this script studies. But then when you actually go down and kind of see this, now if I took the SPX, now what you're going to notice is when the price is actually falling to the downside, you're going to kind of see that more often than not, it's kind of telling you, hey, stay away, right? More red candle, that red shading, red moving average line saying sellers are still in control. So it does a good job filtering out the, helping us stay in the trend, number one, but also staying away from trends that are not trending back to the upside. That might be helpful for bearish. Now, if we said one other one just real quick, is obviously the trend candlestick. The trend candlestick is going to be the closest thing you can really get to Hawkinashi candlesticks, okay? And these, remember, these green candles are going to be very similar to that. When you see orange colored candles, it's kind of more of a consolidation. Purple colored candle, slight dip in the price down below the 10. But when you start to see more of a severe sell-off, you're normally going to notice that those moving out, the color of the, you got orange or purple. If they stay purple for longer, what that means is you're now below the moving average and you're looking up at the moving average, which means you're losing momentum. Steeper sell-off red candle. So if I kind of said, look, if we had to go to battle with 2 different tools, we'd probably say Hawkinashi candlesticks and the trend candlesticks. But the biggest thing is holding yourself accountable to trying to ride those trends. Now, James, that sounds like so two-faced-ish. You say that, but yesterday in the paperMoney account, you sold Intel. We did sell Intel because normally we don't see stocks go up 56% in like 2 weeks. And we talked about that we said before is that investing is about math and psychology, okay? Discipline. When you look at, let's say, the odds of actually a stock going up 56% in 2 weeks, it's not extremely high. That is not to say that if we pull back down to this white line, the red line, the yellow line, it's not saying that we can't buy it back. But when we saw that yesterday, that we were outside the 10% line above the 10-period moving average, the light blue line, statistically it becomes harder and harder. Now, if you're a fan of joint probabilities, you know that what's the chance of it staying outside there? 2.5% chance or less, 2.5% chance, 2.5% chance, 2.5% chance. You multiply that together, you say there's less than 1% chance it could stay up there. Okay? So yes, we did sell into that, but Chevron was not an example of that, where we just saw the trend was just trending. It stayed closer to the 10-day exponential moving average and was slowly grinding to the upside. So there's a difference in like what the move we saw in Intel and let's say Chevron. Now I'm visually going to kind of make mention of some. Keep an eye on Google. Keep an eye on GEHC. Keep an eye on Netflix, GM, Ford, SPG, PSA, CCL, RCL, NCLH. Marriott actually almost hit a brand new high. Hilton actually is trying to push as well. eBay and ALB. These are not recommendations, but based upon our discussions of trend and continuation, these are going to be some examples that we could look at throughout the week. Now, today we kind of went back to some of the questions you've actually had, and I also see some other questions. I'm going to answer those throughout the week. And also want to kind of make mention of, we're still kind of in that process of trying to ride that trend. And the biggest kind of takeaway that we would say from today is the likelihood of us actually taking out 7,000 on the SPX has become a lot higher. Okay, so that's going to be a kind of some conversation. Now, remember, with what we discussed here today, it was done for example, illustrative purposes only. Thanks to Barbara. Barbara will be teaching this afternoon. Join her. Also, rejoin us actually right at the top of the hour in our next session. Thanks so much for your comments and your participation. This has been the class on the Investing Master Series with a focus on short puts. Ride that trend, time decay, and that volatility contraction. Thanks so much. Take care. Goodbye.